Impax Asset Management is a money manager. We manage money for pension plans, for private banks, insurance companies, and we invest in solutions to environmental problems. So in real estate, we're improving energy efficiency of buildings. In infrastructure, we're building the funding the construction of wind farms and solar projects. And in the stock market, we're investing in listed small cap and mid cap companies that are growing their revenues through the distribution of products that solve environmental problems. So water filtration, energy efficiency, recycling, renewable energy, that sort of thing. So I started Impax Asset Management in 1998, and the real objective that I and my early team members who are still with me had was to really fulfill a passion that we've got for understanding how businesses work in the environmental sector. So we've got science, engineering backgrounds, we're really interested in policy, we're really interested in how business works through M&A, through organic growth. And so that's quite different to a group of investment managers who are somehow trying to save the world or impose an ethical view on the economy. We're really just seeing some fantastic growth opportunities and looking to do a mainstream job for institutions that are increasingly interested in this sort of area. We've been quite frustrated with the work that's been done in many quarters around carbon footprinting, and that's been the common way of measuring climate risk. And the problem with carbon footprinting is A, it's very difficult to manage in a consistent fashion, and B, it's also quite static and backward looking. So we think an improvement on that is scenario analysis of the potential for cash flows of fossil fuel suppliers and other companies with climate change risk exposure to carbon pricing. So the scenario analysis approach really gives you quite a flexible tool to work out the value at risk in today's asset prices. And if you can work out the value at risk, you can start to think about portfolio optimization and potentially a switch from part of your fossil fuel related portfolio into something else. And the something else, which is quite crucial, we think that if investors switch into energy efficiency, that allows them to dial down their climate risk while maintaining exposure to energy price factor. Investment's absolutely crucial if we're going to reduce global warming, climate change, and adapt to the change that's already built in. And that's sort of obvious in a way, because over the next 20 years, it's expected there'll be something around $30 to $45 trillion of investment in infrastructure. If that investment just compounds a problem of greenhouse gas emissions, then we're into runaway climate change scenarios. So we've got to think about what I would refer to as climate-aware infrastructure finance. That's quite different to climate finance, which tends to sort of compartmentalize the issue into a relatively small bucket. Climate-aware finance means that $30 to $45 trillion of infrastructure investment really all has to be made with a long-term view as to climate risk in terms of extreme weather resilience, and probably also exposure financially and commercially to carbon taxation. If we didn't think about investment at a very fundamental level, then there's no way that we can solve the global warming climate change problem. So it's right at the heart of this issue.